Coffee Shop Financial Plan Guide. If you are planning to start a coffee shop, or if you are currently in the process of developing a business plan for your coffee shop project, you are probably thinking how to build a robust financial plan, allowing you to better understand the business opportunity from a financial and economic perspective. Moreover, if you are planning to raise funding for your coffee shop venture or simply wish to pitch it to an investor, a detailed financial plan is a must to be able to properly gauge the opportunity and make a strong case. In this video, we will discuss the main components of a solid coffee shop financial plan. But before we dive in our detailed guide, you might be interested to check our ready-made coffee shop business plan template that includes an automatic and fully customizable pro forma financial model in Excel tailored to your coffee shop project. Now, let's get started. Coffee shop costs forecast. The first step in understanding your coffee shop business opportunity is to understand the cost involved in launching such a venture. Cost figures are usually divided into two categories: cost of goods sold, also called COGS or direct costs, and operating expenses, also called OPEX, that usually include sales, general and administrative expenses. Direct costs include the costs of purchasing raw materials to prepare your coffee drinks, such as coffee beans, sugar, milk, etc. They also include anything you pay external suppliers for goods that you don't prepare yourself, and that you simply resell to your customers, such as cakes, pastries, sandwiches, etc. On the other hand, operating expenses typically include the salaries you pay your staff, your marketing and advertising expenses, your rent, utilities, phone, internet, licensing costs, etc. These expenses are crucial to help you run and promote your coffee shop, and hence we call them operating expenses. By adding your COGS and operating expenses, you can estimate the total cost involved in running a coffee shop business. Coffee shop capital expenditures. Next, we need to understand the capital expenditures involved in launching a coffee shop business. A capital expenditure, also called CAPEX, is any investment you incur to purchase a valuable equipment or long-term asset such as an expensive espresso machine, furniture for the venue, or an IT system. These are long-term assets that are used for many years, and hence instead of expensing them, accountants usually depreciate them for the duration of the project, depending on current best practices. For example, a company vehicle is usually depreciated for a longer time than a laptop. Coffee shop startup costs. Now that we have seen the different types of costs involved in launching a coffee shop, it is time to evaluate our startup costs. These startup costs are simply all the pre-operating expenses and investments you need to make before your business starts to generate revenue. For example, getting a business license, paying to develop your brand, identity, or purchasing a professional coffee machine are all expenses you need to incur before your coffee shop is operational. Make sure you jot down all the expenses you believe you need to pay for prior to launching your business. Your total startup costs should be usually covered by your initial capital. Coffee shop revenue forecast. Now it's time to forecast your revenues. This step is usually trickier than estimating costs because it involves making many assumptions, such as the number of customers, frequency of orders, average order values, etc. However, by carefully analyzing your sector and business model, you can make educated assumptions that can greatly reduce your margins of error. For example, to estimate your number of daily customers, you can look at the number of people in a certain age group living in your vicinity and start making assumptions based on that. Let's take an example. Suppose there are 10,000 young adults between the age of 18 and 35 living within a 5-mile radius from your coffee shop. And let's assume that only 5% of them will visit your venue at least once a month. Some will visit almost every day. Some will visit weekly, and some others only one time per month. This works out to 500 regular monthly customers. Now, if we assume that each customer will visit the coffee shop twice a month on average, and we assume that the average order value per customer to be around $10, this implies a monthly estimated revenue of 500 times 2 times 10 equals $10,000. Now that you have estimated the revenue for 1 month, you can easily forecast your annual revenue. But of course, make sure to also take into account the seasonality. For example, during summertime, your customers might leave the town to go on holidays, and this might reduce your average monthly revenue in July and August. The purpose is to build a revenue model that is as close to reality as possible, and hence it is always advised to be conservative rather than aggressive with your estimations. Coffee shop income statement, or P&L. Now that you have modeled your coffee shop's cost and revenue, it is time to project your income statement, also called profit and loss statement, or P&L. The income statement starts with your gross revenue for the period, also called top line, and then subtracts your direct costs, or COGS, to arrive at your gross profit. Then from your gross profit, you subtract your overhead costs or operating expenses, depreciation and interest payments to arrive at your net profits before tax. And finally, after subtracting the tax, you get your net income, also called bottom line. So, to simplify things, you can think of the income statement as a series of subtractions applied to your revenue to find out how much profits your business has really created. Then, if you divide your net profit by your revenue, you get your net margin. The higher the net margin, the more profitable your coffee shop business is. Coffee shop cash flow statement. The statement of cash flow is, as its name indicates, a summary of the cash movements happening in your coffee shop business over a certain period of time. First, let us explain the difference between cash and income, as many people tend to confound both. One of the main differences between a cash flow and an income or expense is timing. This means that cash flows do not necessarily follow the same recording date of income and expenses. Income and expenses usually follow the invoice date, while cash inflows and outflows follow the actual clearing or payment date in your bank account. The statement of cash flows is simply the summary of 3 types of cash flow movements over a certain period of time. The cash flows from operating activities. Here, cash inflows are money collected from customer orders, and cash outflows are payments made to pay for COGS, raw materials, and external suppliers. The cash flows from investing activities. Here, the cash inflows are money collected from the sale of a certain asset or CAPEX item, such as an old espresso machine. And cash outflows are money paid to acquire new assets, such as a new espresso machine. The cash flows from financing activities. Here, cash inflows are new funding received from business loans or equity investors. And cash outflows are payments made to partners in the form of dividends, for example. Investors focus a lot on the ability of a business to generate solid and tangible cash flows, which means that it is not enough to have a profitable coffee shop. What's even more important is to grow a venture that generates consistent and significant cash flows. Coffee shop balance sheet. The balance sheet is another important financial statement. It summarizes the assets and liabilities of your coffee shop at a certain point in time, typically at the end of the year. The balance sheet is divided into 2 sections. The first one lists all your short-term assets, cash and equivalents, inventory, receivables, etc., and long-term assets, property, plant and equipment, less accumulated depreciation, etc. The second section lists all your current liabilities, account payable, banknotes payable, etc., long-term liabilities, bank debt, business loan, etc., and shareholders' equity. The balance sheet can be summarized using the following formula. Assets equals liabilities plus equity. Conclusion. This video guide has provided you with a comprehensive overview of what goes into a coffee shop financial plan. Remember that any coffee shop business plan must include a robust financial plan with a detailed cost and revenue model. You can totally build this from scratch, but if you are short on time and wish to avoid potential mistakes, we highly recommend you use our detailed financial model included in our coffee shop business plan template. Visit businessandplans.com for more information.